Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Michael Romer. He's a managing partner over at Romer Debbas. We're going to take a look at SALT and tax reform, how that's impacting blue states, real estate, and potentially the economy. Michael, thanks so much for joining us at Market Site. And SALT, it's a big issue for blue states, particularly in California, New York, where taxes can be as high as $50,000 annually.
It is a huge issue for us, Jill, and as a real estate attorney here in New York, where we're seeing this on a regular basis. From when the tax cuts went live, we had the personal income tax levels drop in most brackets, the corporate income tax levels came down, but when the government giveth, they taketh away sometimes. And in this case, we actually had the SALT cap, where you have a $10,000 cap on the amount of state and local income taxes that can be deducted on an annual basis. Now, in high tax blue states like New York and California, this had a serious impact because we had tax levels reduced. But then along the same lines, we also had a reduction of the deductions. So that had an impact. It's also having an impact on the property values. So when you're looking at $10,000, it's effectively eliminating the ability for many to deduct their property taxes. You know, I have a friend of mine, I was talking to him this morning about this, and his property taxes are $20,000. The cap is $10,000.
Yeah, and I've noticed that too. I was going through the New York Times real estate section this morning, and you could see the reduction in prices just even over a number of 10 to 20 weeks. It's not even the houses that have been in the market for a year or two. It seems as if it really is translating to real estate prices in our market now.
It is, and it is translating, but it's hurting the market's ability to appreciate. So when you're looking at the property values, this friend that I was talking about, using him as a hypothetical, the property value of the home he purchased 14 years ago is basically the same as it is today, but taxes have doubled. And now this person has also lost his ability to deduct those taxes. And that really impacts the ability or the incentive for that person and any person to sell their home,
right,
which is going to have an impact on the amount of deals that we see. So SALT has had a direct impact on, in particular, blue states like New York and California.
All right, now opportunity zones, this was another federal program intended to spark investment, but it hasn't necessarily been playing out as expected.
Yeah, it's been underwhelming, to be honest with you. When the program came, it came out with the best intentions. And the purpose really there was to revitalize low-income areas, to encourage job opportunities by taking properties that might be in poor condition, revitalize them, and businesses to move to those properties. But outside of the funds, and there's a number of funds because you've got over 8,000 opportunity zones in the country. So you have a number of funds that have actually raised significant sums to purchase properties in these areas, but it's heavily been limited to vacant land grabs. And when you're looking at individual investors, I think they're looking more to the traditional 1031 exchange, which is limited to real estate, as opposed to the opportunity zones where you could actually take you could take your gain from capital gains on sale of stocks and other asset classes and use that to actually purchase properties in the opportunity zone and get the tax benefit by deferring the tax on that gain. But most people are really deferring to the 1031.
All right, now moving along to interest rates, that has been a bright spot when you look at the housing market, historically low between 1% and 3%. That's got to be good for housing, maybe not necessarily in New York or California, but other parts of the country, that's got to be helpful for the market.
You have to give the Trump administration credit on this front because they were out in the forefront and very adamant about the Fed not increasing rates. And you had not only no increases, but you had 3 decreases in 2019. And then we got some positive news at the end of 2019 where there really were no plans being discussed to increase the rates going forward. Now, that does have an impact on mortgage rates. You're looking at the 30-year fixed mortgage rate of approximately 3.7%. That should bode well for more activity going into 2020.
All right, now let's wrap it up here with potential policy changes in 2020. What are you looking at there?
Well, one thing that is being discussed that we're hearing a lot about is Freddie Mac and Fannie Mae. It's a tongue twister, coming out of conservatorship, effectively those institutions being privatized. Now, that could have a direct impact on what mortgage rates would look like, how much can be lent. But at the end of the day, I really think that would take a bipartisan effort. And in this political environment, I'm really not seeing that happening. But the Trump administration, that is on the agenda to actually take Fannie and Freddie out of conservatorship.
How come Republicans are looking for the dissolution of these government agencies?
Well, the Republicans in this instance, and in fact, 2 senators are actually proposing a bill now to effectively dissolve these institutions. And I think the thought process there is to privatize and allow the private sector to handle money being lent to the real estate market.
That'll be interesting to see how that could create, the next revolution of real estate.
Yeah, time will tell. It should be interesting.
All right, thank you so much, Michael, for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.